Welcome students and scholars. We have already completed the big picture and the complete explanation of ASC 210. Now it is time to test whether the logic is really clear. This practice video has 12 multiple choice questions and 4 short answer questions covering classification, presentation and offsetting. Treat this like a serious exam practice session, but do not feel tense. The purpose is not only to get answers right, the real purpose is to understand why an answer is right, why the other options fail, and how ASC 210 works in professional judgment. Before we begin, use this 3-step method for every question. First, read carefully. Do not jump to the answer after seeing one familiar word. Second, choose one answer before moving ahead. Commit to your reasoning because that is how exam confidence improves. Third, review the logic fully. The answer slide is not just for checking the correct option. It is for training your accounting mind. In professional exams and real reporting, the wrong options often look attractive because they contain a small piece of truth. Your job is to identify the complete correct answer. Here is MCQ 1. What is the main purpose of a statement of financial position? Read the question slowly and notice the phrase statement of financial position. This is another name for the balance sheet. Think about whether the statement reports performance during a period, taxable income, cash movements, or financial position at a date. Take a moment, compare all 4 options, and choose your answer now. The correct answer is B, to show assets, liabilities, and equity at a point in time. The balance sheet is a snapshot. It tells us what the entity owns, what it owes, and what remains for owners at a specific reporting date. Option A is wrong because revenues belong to the income statement, which covers a period. Option C is wrong because taxable income is a tax return concept. Option D is wrong because cash inflows and outflows belong to the statement of cash flows. So for financial position, always think point in time. Here is MCQ 2, which 2 subtopics are covered under ASC 210. This question checks whether you understand the structure of the codification topic, not just the balance sheet concept. Do not guess from familiar accounting words like revenue, leases, inventory, debt, impairment, or taxes. Ask yourself, what did ASC 210 actually cover in our lesson? Think through the 2 subtopics, then choose your answer. The correct answer is A. ASC 210-10 overall and ASC 210-20 offsetting. ASC 210-10 covers the overall balance sheet presentation and classification rules. ASC 210-20 covers offsetting, meaning when an entity may present a financial asset and a financial liability as a single net amount. Option B is wrong because revenue is ASC 606 and leases are ASC 842. Option C is wrong because inventory and debt are separate topics. Option D is wrong because impairment and taxes are also separate topics. This is why topic mapping matters. Here is MCQ 3. Which item normally appears in the heading of a balance sheet? Before looking at numbers, users need to know whose statement they are reading, what statement it is, and the reporting date. This question is not about note disclosures or tax calculations, it is about the basic heading information. Review each option carefully and choose the one that belongs in the heading. The correct answer is B, entity name identifying the reporting organization. A proper balance sheet heading normally identifies the reporting entity, the statement title, and the date of the statement. Option A is wrong because auditor fees are not part of the balance sheet heading. Option C is wrong because tax rate details belong in income tax disclosures, not the heading. Option D is wrong because inventory costing method is an accounting policy disclosure, not a heading element. So the heading is about identity, statement type, and date. Here is MCQ 4. If comparative balance sheets change presentation format, what should usually happen? This question is about comparability. Imagine current year amounts are shown in one structure and prior year amounts remain in a different structure. That would make comparison difficult and possibly misleading. Think like a financial statement user. What would help users compare periods meaningfully? Lock your answer before moving ahead. The correct answer is A. Prior period information should conform to the current period presentation. When comparative statements are presented, prior period information should generally be reclassified to align with the current presentation so users can compare like with like. Option B is wrong because simply dropping the prior year destroys comparability. Option C is wrong because keeping an old format beside a new format can confuse users. Option D is wrong because equity is a fundamental balance sheet component. Remember, comparability is not cosmetic, it is part of useful presentation. Here is MCQ 5. Current assets are generally expected to be realized, sold, or consumed within what period? This is one of the most important ASC 210-10 rules. Be careful, the answer is not simply 1 year in every situation. ASC 210 uses the 1 year rule together with the operating cycle concept. Think through the exact classification rule, especially the phrase whichever is longer, then choose your answer. The correct answer is B, 1 year or the operating cycle, whichever is longer. Current assets include assets expected to be realized in cash, sold, or consumed during the normal operating cycle or within 1 year of the balance sheet date using the longer period. Option A is wrong because 1 month is not the standard. Option C is wrong because 5 years is too broad for current classification. Option D is wrong because the tax year is not the ASC 210 classification test. For exams, remember, 1 year is important, but the operating cycle can override it when longer. Here is MCQ 6. Cash restricted for construction of a long-term asset should generally be classified as what? This question is testing a classic trap. Cash sounds current, but account name alone is not enough. You need to examine availability, restriction, and purpose. Ask yourself, can this cash be used for current obligations or is it tied to a long-term purpose? Think carefully and choose your answer. The correct answer is B, non-current asset, because its use is restricted for a non-current purpose. Restricted cash tied to construction of a long-term asset is not available for current use, so presenting it as current would overstate liquidity. Option A is wrong because being called cash does not automatically make it current. Option C is wrong because restricted cash is still an asset, not a liability. Option D is wrong because equity represents ownership interest, not a separate cash balance. The substance of the restriction controls classification. Here is MCQ 7. Why are prepaid expenses often classified as current assets? This question is subtle. Prepaid expenses usually do not convert directly into cash like receivables. Instead, they provide future services or benefits and reduce the need to spend cash soon. Think about how a prepaid asset affects near-term liquidity and cash requirements. Choose your answer now. The correct answer is B. They avoid using current assets in the near term to pay for those items. Prepaid insurance, prepaid rent, and similar items are current because they provide benefits within the current period and prevent a near-term cash outflow. Option A is wrong because prepaids normally do not convert directly into cash. Option C is wrong because prepaids are not automatically intangible assets. Option D is wrong because prepaid expenses are assets, not liabilities. A prepaid item represents a right to receive future benefit, not an obligation to pay. Here is MCQ 8. Which item is most likely a non-current asset? This is a classification question, so evaluate each option against the current asset definition. Ask, will the asset be realized, sold, or consumed within 1 year or the operating cycle, or is it held for a long-term purpose? Compare each option carefully, then select your answer. The correct answer is C. Land held as a long-term strategic investment. Land held for long-term investment is not expected to be realized, sold, or consumed within the current operating cycle, so it is non-current. Option A is wrong because a trade receivable due in 30 days is clearly current. Option B is wrong because inventory held for normal sale is current in the ordinary operating cycle. Option D is wrong because prepaid insurance covering next month is current. This question again proves the rule. Classification depends on timing and purpose. Here is MCQ 9. A liability is generally current when settlement is expected to require what? This question mirrors the asset side logic, but now the focus is settlement. Look for the option that describes using current resources or creating other current obligations. Avoid answers that confuse equity issuance, asset purchases, or very long payment horizons with the basic current liability test. Think through the definition, then choose your answer. The correct answer is A. Use of current assets or creation of other current liabilities. That is the core current liability logic under ASC 210-10. A liability is current when its liquidation is reasonably expected to require current assets or create other current liabilities within 1 year or the operating cycle, whichever is longer. Option B is wrong because issuing common stock is not the defining test. Option C is wrong because buying a fixed asset does not define liability current status. Option D is wrong because payment more than 10 years from the balance sheet date is clearly non-current. Here is MCQ 10. Which obligation is usually classified as current? This question is about timing and creditor rights. Do not look only at the label of the liability. Look at whether the lender can require payment within the current period. A long-term maturity may suggest non-current classification, but a demand feature can change the answer. Review all options and choose the best one. The correct answer is B. Demand loan callable by the lender at any time without notice. A demand loan can be called at any time, so the entity may need to settle it using current resources. Option A is wrong because a bond payable due in 12 years is normally non-current, except for any current portion. Option C is wrong because lease payments due after 8 years are non-current. Option D is wrong because far future pension obligations are generally non-current. For liabilities, never ignore demand or call features. Here is MCQ 11. Which condition is required for offsetting under ASC 210-20? This question tests the offsetting gate. Remember, net presentation is not allowed just because management likes a shorter balance sheet or because items are shown near each other in a footnote. The standard requires a real right of setoff, and legal enforceability is a key part of that analysis. Think through the conditions and choose your answer. The correct answer is B. The amounts are legally enforceable for setoff between the two parties. Legal enforceability is essential for offsetting. The right of setoff must actually exist and be supportable. It cannot be assumed. Option A is wrong because management preference is not a GAAP criterion. Option C is wrong because footnote placement does not permit net presentation. Option D is wrong because materiality does not create a right to offset. Even a large balance cannot be netted unless the ASC 210-20 conditions are satisfied. Here is MCQ 12. Which statement about offsetting under ASC 210-20 is most accurate? This question checks whether you understand the general rule and the exception. The general rule is gross presentation. Net presentation is allowed only when the set of criteria are fully met. Do not choose an answer just because it sounds convenient or absolute. Read all 4 options and choose the statement that reflects ASC 210-20 correctly. The correct answer is B. Gross presentation is the default. Net presentation is allowed only if set of criteria are fully met. Under US GAAP, assets and liabilities are generally shown gross. Netting is a permitted exception only when the conditions are satisfied. Option A is wrong because having the same counterparty is not enough. Option C is wrong because management election alone cannot justify offsetting. Option D is wrong because some financial instruments can qualify for offsetting when the standards conditions are met. The memory rule is simple. Gross first, net only if allowed. Now we move to the short answer section. Short answer 1 asks you to explain the operating cycle concept in current asset classification. This is not a one-line definition question. A strong answer should explain what the operating cycle is, how it interacts with the one-year rule, which period takes precedence, and why this matters for industries with long production or collection cycles. Build your answer in 4 points: definition, rule, longer period test, and industry relevance. A strong answer should say that the operating cycle is the average time from acquiring inputs to ultimately collecting cash from customers. It includes acquisition, production, sale, and cash collection. Under ASC 210-10, current assets are those expected to be realized in cash, sold, or consumed during the normal operating cycle or within 1 year, whichever is longer. This matters because businesses such as construction, timber, distilling, and other long cycle industries may have inventory or receivables extending beyond 12 months that still qualify as current. The rule prevents core working capital from being incorrectly pushed into non-current assets. Short answer 2 asks, why may restricted cash be classified as non-current? This question is testing substance over form. Cash sounds current, but classification depends on availability and purpose. Your answer should explain what restriction means, how a legal or contractual restriction changes classification, why the intended use matters, and why the account name alone is not enough. Think through the difference between cash that can pay current obligations and cash that is locked for a non-current purpose. A complete answer should begin with availability. For cash to be current, it must be available for use in meeting current obligations. Restricted cash is not freely available, so it cannot automatically qualify as current. Next, the restriction must be analyzed. A legal, contractual, or regulatory restriction can remove cash from current assets. Then, the purpose matters. Cash set aside for long-term debt, plant construction, or a long-term covenant purpose is normally non-current. Finally, the account name is not decisive. The substance of the arrangement, meaning what the cash can be used for and when, governs balance sheet classification. Short answer 3 asks you to explain current liability classification with one concrete example. This is a definition plus application question. Your answer should define what makes a liability current, identify the 2 settlement methods that trigger current classification, address demand obligations, and give a real-world example. Do not write only due within 1 year. That is incomplete. Think about the use of current assets, the creation of current liabilities, and the creditor's ability to demand payment. A strong answer should state that a current liability is an obligation expected to be settled using current assets or by creating other current liabilities within 1 year or the operating cycle, whichever is longer. The 2 settlement triggers are important. First, payment using current resources such as cash. Second, replacement by another current liability such as a short-term borrowing. A concrete example is accounts payable to suppliers, normally paid within 30 to 90 days using cash. Demand obligations are also current because the lender can require repayment at any time, even if the entity does not expect immediate payment. Short answer 4 asks you to explain the right of setoff using the 4 required conditions under ASC 210-20. This is a very important offsetting question. Your answer must name and explain all 4 conditions, and the key point is that all 4 must be present at the same time. Think like an examiner. A partial answer is not enough here. Build your answer around determinable amounts, right to set off, intent to set off, and legal enforceability. A complete answer should explain all 4 conditions clearly. First, both parties must owe determinable amounts to each other. The asset and liability must be measurable. Second, the reporting entity must have a right to set off, usually from contract, law, or another enforceable arrangement. Third, the entity must intend to set off. Having the right without the intention is not enough. Fourth, the right must be legally enforceable in the relevant jurisdiction. This last condition is often critical, especially in bankruptcy or insolvency situations. If any one condition fails, gross presentation is required. Let us now consolidate ASC 210 using the final revision map. Snapshot, Time netting. Snapshot means the balance sheet is a point-in-time statement anchored by the entity name, statement title, and reporting date. Time means assets and liabilities are classified as current or non-current based on expected realization, use, restriction, purpose, or settlement. Netting means gross presentation is the default and net presentation requires all ASC 210-20 right of setoff conditions. When a question feels confusing, return to these three words. They will usually lead you back to the correct logic. Congratulations, students and scholars. ASC 210 is now complete. You have worked through the purpose of the statement of financial position, heading requirements, comparative presentation, current and non-current assets, current and non-current liabilities, restricted cash, prepaid expenses, demand obligations, and offsetting under ASC 210-20. Remember the final discipline: classify carefully, present clearly, and offset only if allowed. If this practice session helped you, please like the video, share it with colleagues and students learning US GAAP, subscribe to Commerce Regiment, and support the channel. In the next accounting standard, we will continue building US GAAP mastery step by step.